Hello, everyone, and welcome to the latest LPL Market Signals. Jeff Bookbinder here, your host for this week with my friend and colleague, Lawrence Gillum. Lawrence, you must be in a good mood. I believe your football team won this weekend.
All my football teams won this weekend, so it was a great weekend. My college teams won, as well as my Bucks, my Tampa Bay Bucks team. They're 2-0, which is a lot better than I was expecting to start the year. So it was a good weekend.
Yeah, they're one of the surprises thus far. Maybe my Kansas City Chiefs being 1-1 is a surprise, but hey, glad to be in the win column. So here's our agenda for today. We're going to talk about an interesting week, I think, last week in terms of the sector leadership. Utility is one of the worst performing sectors for quite some time. Actually, turned things around and had a really solid week last week. Of course, we'll preview the Fed. That is the biggest event of the week, no doubt. But as Lawrence will tell us soon, we have other central banks that are meeting this week, and those might be interesting as well. Next, the weekly market commentary this week is about the developed international equity markets. So specifically Europe and Japan. So we'll talk about why we've lost some confidence in Europe and are increasingly liking what we're seeing out of Japan. And then finally, we'll preview the week ahead, which is really just going to be a, I guess, verbal retweet. What do you do with X when you retweet? Lawrence, do you know? I'm not sure.
I'm not cool enough. I don't know all the cool lingo anymore. I'm old.
Yeah, well, then I am too. So we're going to do a verbal retweet or maybe a verbal re-X and just say the week ahead, all that matters is the Fed. So let's get rolling. Starting with the weekly recap. Well, I kind of promoted the utilities narrative here. So let's start there. Over the right, it wasn't a real interesting week, I think, headline wise, because you had just the S&P barely moving. But if you look over to the right at the sector leadership, there's utilities up 2.7 for the week. Yet interest rates, as Lawrence knows, as our fixed income strategist, moved higher. So that's a little peculiar. I have two possible explanations. One is utilities were so oversold that they were due for a bounce, and people are just buying it as a mean reversion play as opposed to any sort of interest rate trade, right? That's one theory. The other theory is that we are maybe going into a weaker period for markets, which would suggest maybe buying more defensive sectors. And staples were up a little bit, so that was a mild outperformer. Healthcare up a little bit, mild outperformer. I'm just not sure that that's enough evidence to suggest the market is signaling a downturn. Now, we've been in the camp of, choppy markets, fully valued, maybe, buy on weakness. So, that would be consistent with our call if that's what was going on. I guess the other thing that jumps out at you is tech weakness, right? Down 2%. We had a little bit of sell the news maybe with the Apple new product launch. But I actually think that Taiwan Semiconductors, I guess, reduced guidance, essentially, saying that they're going to spend less on capital equipment, semiconductor capital equipment. That caused markets to drop on Friday. So really, we were up for the week heading into Friday. It was just, it was kind of all about Friday's declines. So I thought that was interesting. Consumer discretionary, the breadth is weakening a little bit. We recently upgraded it to neutral. Tesla was up 10% last week. That was certainly a big reason why that sector was up. So we wouldn't read that necessarily to mean the consumer is strengthening right now, but still good to see, solid gains, enough gains to kind of offset the losers and, leave stocks kind of flat. International markets were pretty good last week. We had actually solid gains out of Japan. You see here up almost 3%. We're not showing Brazil, but that was one of the best markets last week. Certainly helped emerging markets. And then the dollar was down a little bit last week, which helped international. So turning to fixed income, Lawrence, I mentioned that rates went up a little bit, which made it a little bit surprising that utilities did so well, but certainly bonds were down in the face of rising rates.
Yeah, we did see some yields move higher, particularly on the back end of the yield curve. Not a big move higher in yields relative to kind of what we've seen over the past, call it, couple of weeks, but the 10-year and out tenors, so 10 years, 20 years, 30 years, they're up above, they're up higher by about 4 to 6 basis points. So not a big move, but a move nonetheless higher in yields. Spreads for a lot of these spread sectors, those were relatively unchanged as well. So it was kind of a quiet week as well on the fixed income side. I think a lot of the activity or a lot of the wait and see is happening this week because we have that big Fed meeting. But yields were higher, but it wasn't something that kind of was alarming in terms of movement. They just kind of kept leaking higher as the week progressed, but nothing that was, I would call, out of the ordinary.
Yeah, we got inflation data, we got retail sales data, all of that put together was maybe a tiny bit hot. So a little bit of the rate move probably was just a function of the economic data, but you may have also had some positioning ahead of the Fed. Turning to commodity markets, energy jumps out at you, of course. Oil was up even more than the 2.3% that the energy commodities complex was up. Oil is now on Brent flirting with $95. So, this has been a pretty big move. I think WTI at last check, 91. It's Monday afternoon, September 15th, 2023, as we're recording this. We've upgraded the energy sector. We like it. It's actually our favorite sector for LPL Research right now, tactically. There's some talk, though, that maybe it's gone a little too far too fast. So we'll certainly be watching. Crude oil, certainly $100 would be a psychologically tough number to break through. But for now, we like it, and we still think the stocks are attractively valued relative to the commodity and relative to the cash flows. So let's move on. The S&P 500 did dip slightly below its 50-day moving average last week. So did the NASDAQ, but again, these moves were not very large to the downside. My view is that we're going to have a little bit more weakness maybe in the S&P, and then you'll have the 200-day move up. And at some point between now and the end of the year, I think those are going to meet. And, that doesn't mean we're going to go down to, 4,100, 4,150. But certainly something in the 42 to 4,300 range is a reasonable place for the market to dip to. But at the same time, we recognize there's a good chance probably of a Q4 rally. So maybe we dip a little bit more in September. It's a very seasonally weak period on the calendar, and then we go higher late this year. There are a number of challenges. Many of these we've been talking about really all year, with inflation and rates. And geopolitics for that matter. But, we haven't talked about government shutdown. That may drive a little more volatility. We've got the United Auto Workers strike, which a lot of people are talking about now. There's student loan repayments starting up again in a couple of weeks. So there's a number of other challenges that are coming that are a little bit newer that may, lead to a little bit more of a dip here in the short term. So here's the seasonality I just mentioned, right? This is from Bespoke. They do some really great work around seasonality. So you see in red, the 2023 line, we had the big rally, of course, and now we're coming back a little bit off the recent highs. Historically, the market bottoms in mid to late October, and then we get a Q4 rally, which on average is about 4%. So we're not going to say that this is going to happen. Obviously tough to predict and a lot of time between now and the end of the year, but there's certainly going to be a seasonal tailwind coming maybe in about a month. So if we can get through these next couple of weeks with limited damage, maybe we'll have a market that ends the year higher than where it is now. So Lawrence, what do you think of the 10-year treasury yield chart? We got really close to breaking out to a new 1-year high, right?
Yeah, we have bumped up against that 433, 434 on an intraday basis. We've maybe gone a little bit higher than that, but yeah, it is providing some solid resistance in terms of not not being able to move through that 433 line pretty convincingly. As you point out here on the chart, that next key level is 450. After that, it seems to be a pretty empty runway between 450 and 5. So there's, I mean, if we do move higher here in the near term and we do eclipse 433, 450 would be the next level to watch. And then after that, I mean, it could be 5%. Now, a lot of this is going to be predicated on what we see and hear from the Fed over the next couple of days, right? So if we do get this, and we'll talk more about the Fed in just a second, but if we do get a pretty hawkish message out of the Fed this week, we could see upward pressure on yields. Or if we continue to see better than expected growth coming from just from the market itself, or the economy itself has been really resilient, and that has helped push yields higher. That's kind of how we keep getting these higher yields in the near term, because the economic growth has been better than expected. So if that continues, or if the Fed provides a bit more of a hawkish response this week, we could start to see some yields move up against that 433 and possibly through it. But it's been unrelenting as a fixed income strategist. We've had pretty much higher yields each week for the past couple of months, and hopefully this 433 holds.
Yeah, and then you're maybe talking about that 375 target that research has had for quite a while, at least at the upper end. So you might see some folks buying treasuries just because that holds, from a technical analysis perspective. So let's hope so. I mean, the inflation data didn't really change the narrative too much. Maybe you'll have more focus on deficit spending as we try to solve the government shutdown problem. I'm not sure. We still have a lot of treasuries, right, Lawrence? A lot of issuance to digest. I mean, I would think that would focus more on the shorter end.
It's going to be mixed. There is a lot of issuance coming to market. So far, Treasury has concentrated that issuance in the T-bills or the 1 year in maturities, but there's an expectation of more duration or more coupon issuance in the coming months and quarters, which again could push yields higher again. Because to your point, there is a lot of supply coming to market. At the same time, the Fed is winding down its balance sheet, so it's trying to take a step out of the Treasury market. We'll talk more about that in just a second. And then you have foreign investors who have been, they've seen their yields increase as well in their home countries. So the attractiveness of U.S. rates relative to their home country rates has diminished. So the buyer base for treasuries is pretty diverse, but it is shrinking. At the same time, you have Treasury wanting to issue a lot more debt to satisfy these budget deficits. So it's could potentially set itself up for a perfect storm in terms of too much supply and not enough demand, which would push yields higher.
Well, I think this is the most important thing to watch for equity investors, because if you go much higher than this, makes it tougher to justify stock valuations because of that inverse relationship between valuations and interest rates. And then certainly I'll make the assumption that if you're going to have a meaningful spike in rates that somehow sustains itself from here, it's going to take a re-acceleration in inflation. And of course, stock valuations don't like inflation either. So we kind of teased the Fed a little bit here. So why don't I just hand it over to you, Lawrence? You put a couple of slides in here. I guess what should people be looking for from the Fed? I guess we get the new SEP, right? The Summary of Economic Projections on Wednesday, as well as of course, the rate decision. How hawkish or dovish do you think they're going to be? What might the implications be for that?
Yeah, for sure. So last week we had the ECB engineer a dovish hike. This time we're looking at the Fed as a hawkish pause. So I guess you have to throw out some clarifying adjective, relative to kind of what the Fed or the ECB does or doesn't do. So we don't expect the Fed to do anything this week in terms of rate hikes. There is the expectation of a pause for the September meeting. What is or could be potentially interesting is to your point, Jeff, is this summary of economic projections, and along with that SEP, you get these new dot plots Now, dot plots, they're not particularly accurate in terms of forecasting, but it does give a glimpse into how each of the individual FOMC members are thinking about rates. That's what each individual dot represents. It's the individual Fed members' expectation of where the Fed funds will end at the end of the year. There shouldn't be much change, I wouldn't imagine, out of the 2023 dot plot. I think there's going to be some some more kind of normalizing around that 565 number. So it would give the Fed some optionality to raise rates one more time if they want to. I think what we'll see in terms of the biggest change could be for 2024, and in terms of the expected rate cuts, right? So we could see a Fed funds dot plot rate a bit higher than what we have here on the screen, which would likely cause fixed income markets to reprice higher as well, to price out some of the rate cuts. Now, markets have normalized a lot of these rate cuts, and right now I think there's only about 3 rate cuts that are priced in, which is much, much better than what we saw about 6 or 9 months ago, when markets were pricing in 1.5% of rate cuts, which we said at the time was probably unrealistic. So you could see some rate cuts being priced out, which could push Treasury yields higher. The other thing that could be interesting is the longer term dot plot. It's been kind of stuck at 250 for a while now, after Jackson Hole and the discussion around what the neutral rate is, or the rate that's neither accommodative or restrictive. There's discussion that rate could move higher as well, and that would of course cause some upward pressure on yields as well. So it looks like this dot plot could be a more hawkish release than what we saw in June, which could in fact put additional pressure on yields. But it's all about the dot plots, and it's all about what Jerome Powell says after the release. So during his press conference at 2:30, he'll have his comments, and he'll take questions and answers, and it's usually during that press conference where there's additional, call it fireworks, that come after these meetings. So not expecting a lot in terms of rate hikes, but it's about kind of forward guidance, if you will, in terms of what rate hikes or cuts could look like over the coming, call it 12 to 24 months.
Yeah, I guess if you look at all the inflation data we got, everybody's slicing and dicing it all 100 ways. But you did see, it was largely energy prices, right? You did see a little bit of an uptick on certain measures. So I think that's probably prepared the market for a touch of hawkishness. But if it's too strong, then sure, you're going to see bonds sell off, no doubt. So I think this will be, all these meetings are pretty interesting. But this one I could see, varying degrees of hawkishness, right? There's maybe a wide range of how much hawkishness we could get, because the inflation data generally is trending lower, right? And with each passing meeting, you have, more time in a restrictive stance, right? And we're still seeing credit conditions tighten generally. We're getting closer to some more of those headwinds that I talked about. And by the way, if oil prices are, go higher and stay there, that's going to have an economic impact. And so it's going to be even tougher for the Fed. Of course, that should be temporary. It's going to be tougher for the Fed to hike into a more challenging environment for consumer spending. So, it'll be interesting to watch. And I could see this going a number of different directions in terms of the amount of hawkishness we get. So I guess, here's the balance sheet. So I'll let you talk about this, Lawrence. But I guess one other question I have is what happens to the yield curve, right? Because I think this is an all-time record for documented yield curve inversion. Is
it
that
is
right?
In terms of days. I think your ex, or maybe he's still on faculty at Duke University. What's his? I can't remember his name.
Cam Harvey.
Cam Harvey. Right. So he came out and kind of maybe clarified some things that, based upon monthly inversions, it's not an all-time record, but daily inversions, it is. He prefers to look at monthly inversions. So bottom line is the yield curve has been inverted for quite some time, and it looks like it's going to stay inverted for quite some time. until the Fed starts to cut rates maybe in 2024. So it's going to depend on, again, that dot plot and what those Fed members are thinking in terms of when rate cuts are going to happen. But it looks like we're in this kind of inverted yield curve for at least another, I'll call it 6 to 9 months. Now, what could disrupt that yield curve inversion is quantitative tightening here. So this is the Fed's balance sheet. As we know, that the Fed owns a lot of Treasury securities and a lot of mortgage-backed securities. Their balance sheet got as high as $8.5 trillion. They've reduced it by about $1 trillion. So they've made some headway in reducing the size of their balance sheet. Now, if they sped up quantitative tightening, so if they let more of that, call it 95 billion of treasuries and mortgages roll off their balance sheet each month, if they were to speed that up, you could see higher yields on the back end of the yield curve, because that would, again, push more of the treasury supply out to the market. They would have to digest that, and that usually ends with higher yields. But I think quantitative tightening, Fed balance sheet, is going to be a 2024 story. Like I said, they've done a lot in terms of reducing the size of their balance sheet, but we're getting close to the Fed taking out too much liquidity right now. So the reason why the Fed is reducing the size of its balance sheet is they're trying to drain excess liquidity out of the financial system. As you can see, in 2020, the Fed bought over $4 trillion worth of securities. They're trying to reduce that footprint, and they do that by taking liquidity out of the financial system, usually or primarily through the banking system. But there's going to be a point where they maybe take too much out, and then they'll have to stop rolling off debt and maybe go back to actually buying Treasury securities. So I do think this is going to be a 2024 story. I like why I included this time, because I think as the narrative shifts from rate hikes and rate cuts, I think Fed balance sheet is going to have a bigger impact on markets, particularly the fixed income markets, into 2024 and until the Fed is too restrictive, which we think is going to happen sometime next year.
Yeah, I mean, even the folks or a lot of the folks who called the soft landing this year probably think there's a decent chance that we enter recession before the end of next year, right? So if you just say we're going to have a mild economic contraction at some point in 2024, that should put downward pressure on rates, and that should facilitate Fed cuts, right? So, I mean, you would expect yields to move meaningfully lower in that scenario, right, Lawrence?
It's gonna. I mean, there's a lot of kind of wonkiness that goes into that answer. It's going to depend on the neutral rate. It's going to depend on the term premia. It's going to depend on how aggressive the Treasury Department is issuing new debt to fund those deficits. My view is that we're not going to see long-term rates fall as much as they have historically, absent a deep recession. So if it's kind of a garden variety recession, you could see long end yields fall 100, 150 basis points, something like that. But to get the 10-year Treasury yield, which is at 4.31 now, to get that back into the 2% range, we're probably going to need to see a Fed funds rate at 1%. And I think that only comes about if there's a very hard landing.
Sure. Yeah, I mean, I was thinking more like 3, not 2 or 1, long way down for that. But sure, I think it's important for all of our listeners to know that there are other dynamics beyond just economic growth and inflation that influence rates. So good perspective there, Lawrence. Certainly we'll keep watching the bond market really closely, whether it's a Fed week or not. The bond market is as important as it's been and as attractive as it's been, frankly, in quite some time. So let me just quickly review the weekly market commentary, which I think is a good one, where we spent most of it talking about Europe, and you'll see my charts are all focused on Europe. But really, the key takeaway is that Japan looks really good. And you can still actually like IFA, or at least slightly overweight it on the basis of a real strong positive view of Japan, even if, Europe doesn't look so great. It's not a disaster by any stretch, but it doesn't look very good right now, frankly. So here's our first chart. This is the global PMIs. if you look back to the start of this year, there was a lot of green here, February through May. And you see in the Eurozone, which is the fifth row, right? That was accelerating. I mean, we went from 47 in October, steadily higher through April of 2023 to a really strong reading of 54.1, right? That was apparently a head fake because we've reversed lower. And now the Eurozone is actually the weakest global PMI reading. These are composite readings, so they incorporate services and manufacturing. We're at 46.7 now. And, it's no surprise that that's worse than the US. And it's no surprise it's worse than Japan. But look at China. China's 51.7. And we, talked for many months about how weak China is, how disappointing their reopening was. So that 46.7 is a very weak reading. So the economic momentum that Europe had is really gone. One of the reasons we got more interested in Europe 6 months ago was because we had, a weak dollar. Well, we don't have that anymore. So the dollar has pretty much gone straight up over the last couple of months. It's about a 5% rally. And it looks like it might be poised to break out, as you can see on this chart, approaching 2023 highs. And we've kind of lost the ECB as a catalyst for a weaker dollar because they're now potentially done with their rate hiking cycle. They might even be done before the Fed. That is certainly not what we thought a year ago when it looked clear to us and to markets that the ECB's campaign was going to take longer. So it's tougher to be a dollar bear, even though we think the long-term path of the dollar might be negative. In the short term, it looks like it's going higher. We also like the earnings momentum 6 months ago in Europe. Well, that's reversed too with the economy. So you can see here the European index from MSCI forward earnings estimates have been dropping the last couple of months as those PMIs have been dropping. Meanwhile, we see Japanese and US estimates rising steadily. So certainly this looks like a better investing backdrop for the US and Japan relative to Europe. Now, the best reason to own Europe is valuations. Frankly, that's probably the best reason to own developed international broadly right now. But we want to make the point here that Japan's actually cheap too. So you see here in this table, Japan's below a 15 forward PE. That's pretty close to the 10-year average, and it's still more than 20% cheaper than the US. So even though Europe is cheaper, we think Japan represents really good value, especially considering Japanese companies are emphasizing adding shareholder value now, much more than they have in the past. And then last thing on this, if you adjust for sector mix, right, because Europe really doesn't have much tech, it's kind of a defensive, slow growth market. The gap between Europe and Japan gets a little smaller. So Japan looks a touch cheaper, given it has more exposure to the more richly valued sectors. Not as much as the US, but more. So the last point on this, you don't have to be a technician to know that, based on this chart, Europe has not kept up with the US, right? I'm sure many of you know that. It has, not only has the US outperformed Europe, it's outperformed Japan as well. Although if you adjust Japan for currency, because the yen's been so weak, it's done a lot better. But still, this is in dollars. And the US has therefore outperformed IFA significantly, while those markets have pretty much done nothing the last 5 years. So this is all just to say that technical analysis tells you that Japan and the US are a better place to be. So, I know that sounded a little bit bearish on Europe, and frankly, we are recommending we underweight Europe a little bit, but valuations are pretty compelling, and certainly US markets look a bit expensive. So we're not going to get too aggressively underweight Europe. We are talking in our tactical asset allocation committee about potentially pulling back a little bit on IFA because of this kind of waning economic and earnings momentum in Europe and the weaker performance. But as of now, we're still sticking with our slight overweight to developed international equities. But that comes from the emerging market underweight. So we're neutral US. All right. So with that, again, weekly market commentary. I just hit on the charts and some of the key points from that. That's available on LPL.com. So let's do the quickest week ahead preview ever, Lawrence. What should investors be watching this week?
Oh, it's all about central banks and the Fed primarily. Fed meeting starts on Tuesday, starts tomorrow. We get the rate decision on Wednesday at 2:00, and then the press conference at 2:30. We also have the Bank of England, who is expected to raise rates by 25 basis points or a quarter of a percent on Thursday. And then the Bank of Japan remains a wild card. They meet on Friday. The Bank of Japan President Ueda has been kind of teasing about the end of yield curve control. Probably won't happen this week, but maybe there's some additional conversation about eventually reducing that aggressively accommodative monetary policy that they've had for over a decade, for quite some time now. So maybe even Japan is entering a new regime with higher inflation, higher rates, and which, if you ask me, Japan raising rates anytime soon, I would have said no way. But maybe we're in this kind of new normal where rates are going to be higher than they have been over the past decade. So central banks are still, driving a lot of the market volatility, particularly in the fixed income market. So got to watch the central banks.
Yep, that's it. I mean, leading index continues to point to recession, but it just doesn't come, and it's probably not coming in Q3 based on where the GDP trackers are. I mean, we could have 3% GDP growth in Q3. So we'll see when the economy peaks and turns lower enough for the National Bureau of Economic Research to call it a recession. They're the official arbiter of recessions, but it's probably, good couple quarters away at least at this point. But nonetheless, people are still going to talk about the LEI and the yield curve as recession signals. So thanks for that, Lawrence. I think the Bank of Japan is going to be really interesting, just because, the market knows that at some point they're going to pull back, right, and kind of let yields rise a bit. But they've had such a hard time beating deflation for so long that they're going to be careful, right? And so that's, maybe you'll see another hint. Maybe you'll see another very small move in that direction before they, get to sort of a full hike or a full elimination of yield curve control. But watch the yen, because it's going to be volatile probably one way or the other. And that is a really important element of your Japanese returns if you're a US based investor. So it's a tough call to make, but maybe right now, unhedged might be a better way to play Japan rather than hedged. We'll have to see.
Just one quick comment on Bank of Japan versus the Federal Reserve and other central banks. The Federal Reserve and other developed central banks, they go out of their way, frankly, to tell us what they're going to do before they do it. The Bank of Japan and call it the Bank of Australia are on the other end of that spectrum. They try to surprise markets at times. So that's why I'm kind of thinking Japan's a wild card this week, because you just don't know what to expect from their central bank decisions. So it wouldn't surprise me if they do nothing, and it wouldn't surprise me if they lay the groundwork for the end of yield curve control. So definitely keeps it interesting, though.
You got to love ending a Market Signals podcast by saying we have no idea what's going to happen. So no, I totally hear you. It is, Bank of Japan is a wild card. We've had debates in our asset allocation committee where we've, some folks have come down on opposite sides, right? So I guess that's what makes a market. So, obviously watch the Fed. That's the big event of the week. But, carve out a little bit of time for the Bank of Japan on Friday before you start your weekend. So thank you so much, Lawrence, for weighing in. It's Central Bank Week, so I definitely think that's a great time for for you to join. Thank you to all of our listeners. We will see you next week for another edition of LPL Market Signals. Take care, everybody.